Good afternoon, everyone. Thank you guys for being here. I want to thank the panelists here as well for the time here. It's going to be an exciting panel. Stablecoins, especially in the past few months, have been top of mind and a hot topic, and so excited to dive deeper. We have Nick Van Eck here, Austin Campbell, Corey Thane, and Jack McDonald. Instead of spending time on intros, we're going to just dive right in. So stablecoins. Before we dive in, it would be just great to get kind of how you guys think about what the definition of a stablecoin is. There's a broad range of stablecoin definitions, and maybe as you talk about that, kind of what are some of the risks around stablecoins? What are misconceptions around it? So I'll ask Austin and Nick to start that off.
All right, I guess I'll go first. So on the inside, I'm still fundamentally a grouchy fixed income trader from JP Morgan, despite being in crypto now. And I think one of the critiques I have of the crypto space is calling a whole bunch of things stable coins, which are patently not. I think an appropriate definition for them is the representation of a dollar on a blockchain in a way that we genuinely believe could hold the peg over time. And there are right ways and wrong ways to do that we've learned from 2008. And it's one of those like, crypto keeps trying to reinvent the wheel, but in this case, guys, we've got a wheel and it works fine.
Yeah, I won't add much to that. I think it's very clear what a stable coin is. It's something that's fiat collateralized and can hold its peg and looks pretty much just like a money market fund. So it's very vanilla. I think there's a lot of different definitions that people have been throwing around. Some structured products that are calling themselves stable coins because they represent $1, but I think it's kind of like the fixed income market. It's like a treasury is a treasury, like a junk bond is a junk bond. And I think stable coins are the treasury grade products, and then everything else is something else, right? So it should be fairly straightforward, but people like to make it not.
Yeah. Anything else out there?
Yeah, can I add something to that? I'm Corey from Circle, and I've worked on stablecoin legislation for the last couple of years. If you want a definition of stablecoins, just go out to either New York Department of Financial Services guidance that they have already issued, or some of the draft bills we call the McWaters bill. McHenry and Waters have worked together in House Financial Services for 2 years. I think the essential element of a stablecoin is high-quality liquid assets that can be redeemed with speed and that are not volatile in your reserves. So it's defined by the sort of like basket of goods, and we know what those are. It's already been published. I don't think that there's any reason to try to remake the wheel, right? But if you fall outside of that, then I think you start looking like a different type of instrument. If you have like Bitcoin, gold, like volatile assets, maybe it's a synthetic derivative or something like that, and there can be usefulness to those tokens, but I personally wouldn't consider those stable coins.
To the second question you asked, Sunny, that what are the misperceptions? I think one of the big misperceptions, as you're hearing, is that all stable coins are equal, and they're not. Whether it's a licensed approach, what type of entity you're in, as you were just saying, the construction of the reserves, the transparency around it, what sort of regulation you may or may not fall under, I think is where there's a big discrepancy and disparity between different stablecoin issuers. And I think we're seeing that today as more and more issuers are coming to market with different types of offerings, all under this uniform cloak of a stablecoin. But they really are different.
Yeah, and that's very helpful. And we'll talk a little bit about market structure and how the evolution of stablecoin markets and your views there. But I think before we dive in there, would love to just understand kind of some of the use cases you're seeing. I think things like remittance, treasury management, and across geographies are quite different. What you see stablecoin use cases being in the near term, and then perhaps also how you and your organizations are helping to drive that adoption of use cases. So we'll start with Jack.
Yeah, we decided to launch a stablecoin at Ripple for a number of different use cases. I'd say first and foremost, Ripple has been around for 12, going on 13 years as a leading cross-border payments company, and we've been a net user of stablecoins increasingly over the last 5-7 years. And so that use case really, in part, drove our decision to ultimately launch our own. And we ultimately believe that stablecoins really the killer app for cross-border payments. In addition, we've got a custody business, which is increasingly focused on the tokenization and RWA space, the previous panel. Stablecoin's a perfect on and off ramp 24/7 to be able to allow more users to access RWA specifically, and doing a lot within the XRP ledger as well. So we see a number of native use cases in addition to the trading sort of applications that stablecoins are very popular for today.
Just on these use cases, maybe to just conceptualize it, can you share an example of where that Ripple stablecoin is being used, whether it's trading or and some of the other use cases?
Yeah, specifically in trading, again, the previous panel spoke about DeFi. It's a perfect instrument to gain access on and off different DeFi protocols or platforms. And again, the 24/7 nature of it is really powerful. On the payment side specifically, there are certain corridors or senders or receivers who aren't comfortable using cryptocurrencies, for example, where stablecoins can be an alternative, and given the peg to, in most cases, not always, but in most cases, to a fiat currency, that can be a settlement token that has many of the same features as cryptocurrency in terms of speed, resiliency, efficiency, security, but to be able to be used in a very cost-effective way. And so, as I mentioned, we've been a net minter of stablecoins, specifically USDC, quite a bit in our business. We'll continue to do that, but also introducing RLUSD, the Ripple stablecoin.
Speaking of USDC, Corey, I'm sure you've seen a whole host of use cases around stablecoins. Where have you seen kind of the critical mass of them, or a lot kind of where the demand is going to be generated over the next couple of years?
Yeah, so for those of you who aren't familiar, thanks for bringing up USDC, because I sort of buried the lead there. But Circle is the largest American issuer at the moment, and our stablecoin is USDC. What we think we're doing is essentially a financial markets infrastructure upgrade, with the blockchains being, these incredibly innovative new pipes. And we just want to be the boring instrument that moves on it. So anything that you can do in traditional finance, I think, will eventually be done on the blockchain, and you're going to need stable coins for that. Now, we started with crypto capital markets as the bootstrap use case, and that will always be there. There will always be crypto traders and the like. But you're already starting to see now, like, BlackRock use it for their tokenized money market fund. We're getting contacted by, investment management associations saying trading closes in Europe earlier than in the States. Can we use USDC as a settlement mechanism? Some banks that don't want to go through the correspondent banking network but have a lot of clients abroad, they want to use USDC as a settlement layer, right? So I think the sky is the limit, and it's the only limit is our imaginations.
Upgrading the rails is something that resonates. Nick was a former fintech investor as well as myself. And Nick, as you bring on Agora, what's the perspective you're seeing in terms of use cases and some of the early adoption?
Yeah, I mean, they already touched on trading and payments, so I'll touch on what I think is the next 100x, right? We didn't launch this to compete with USDT on BTC price discovery. I think speculative crypto is in its sixth inning. I think we're in the first inning of real crypto, which is all of traditional financial services and payments moving on chain. So we're heavily focused on cross-border payments. I think RWAs, which I think is a bad term, but this is another conversation, are going to start to take off in a really meaningful way in the next 3 to 5 years, as you have the traditional banking system, custodians, exchanges, prime brokers actually interact with those assets. That's where I think we'll see a true 100x beyond cross-border payments, on-chain FX. So today, US dollar stables are really the only currency that's on-chain in a meaningful way. I think you'll see non-US stables start to crop up over the next year as people look to settle both legs of the trade fully on-chain, because that's the only way that it actually becomes scalable. We've been looking for good partners to collaborate on with that, because we don't want to do a non-US stable. And there are a few that are starting to emerge. I think that's another 100x. And then something that's been a little bit of a surprise for me is actually gaming. I was never a believer in gaming on the blockchain, but I think blockchains are actually getting integrated into games in a really interesting way. And so we've been approached by many gaming studios that are looking to effectively have their in-game token, whether it's called like a gem or something else, that is effectively a wrapped version of a US dollar stable, right? And so we're working with many different gaming companies across different networks on that, and that's been a little bit of a surprise and something that I've had to change my perspective on.
That's great. Austin, you've put on a bunch of different hats in the stablecoin world. I know there was a lot that was covered. What haven't we covered, or something you want to double click on around the stablecoin use cases?
Yeah, I mean, so to Nick's point on the 100x, it's very important to remember that stablecoins, currently, if you round all of them up, are still under about a 200 billion notional threshold, and global monetary flows are in the many, many trillions of just resting dollars. I think people underestimate the importance of 24/7 trading venues. We talked just very briefly about avoiding correspondent banking, but I'll take that a step further and say completely replacing correspondent banking is something that should probably happen. And specifically about use cases, it's not just because, it's faster and cheaper. Like, okay, yeah, that's nice. It does help. But it's also dramatically risk reducing for the entire system. So like, being a person with some gray hair, if you remember things like Herr Stadtbank, which, is this German bank where people would send Deutschmarks at the time, this is back before the euro, and then get dollars out at a later point in time. It failed in the middle of that transition at one point, which was a cluster, okay? And if you're using a blockchain, yeah, the 24/7 instant settlement is fast, but fundamentally you need a stable coin to do a more important thing, which is instantaneous settlement without counterparty credit risk. So I think that movement on rails is going to be the thing that causes a lot of global regulators to reconsider their views on stablecoins and realize they've missed something big. Because theoretically, if you could take about half of the grit that happened with all the bankruptcies in '08 and just get rid of them instantly, the world is a much better place.
Well, on that point, I mean, obviously, there's a lot of these use cases. There's a lot of opportunity. Corey, if I may ask, where do you see, whether it's regulatory or what unlock will kind of drive that next level of growth? Is it more focused on use cases, regulatory?
I think it's two things, right? One, just more developers coming into this space and writing to the blockchain, smart contracts. And that's where creativity comes in, right? I mean, this is like when HTTP was an unlock for the sharing of information and people just went out and started making web pages. Now you can do that for the exchange of value on the blockchain. So I think that is a huge unlock. The other one is legislation. You're seeing global governments move forward. I mean, Circle, we also have a euro-denominated stablecoin called EURC. We're the only stablecoin issuer at the moment licensed in Europe under its big MiCA law, which is broad, huge crypto bill that covers market structure, and stablecoins are like one sliver of that. We're already licensed in Singapore, UAE is moving forward, and everyone is just waiting for the United States. Despite the fact that we've been negotiating this for 2+ years on something that, in my view, is actually pretty simple and plain vanilla type legislation. When the U.S. actually passes something, the world will look to us, right? I mean, it's our currency. And I think that will unlock stuff like doing business with major retailers all over the world who want to speed up their money cycle, right? I mean, at that point, the sky's the limit.
I would just echo that. 90+% of demand for stablecoins today globally is in U.S. dollars. And to Corey's point, I think having a U.S. regulator really lean in here and finally provide some tangible guidance will unlock the next level of demand. We talk a lot about institutions coming, and you've seen a whole litany of different major institutions have their own respective experiments around tokenizing a bond issuance or having a money market fund. But these are small pebbles, in what ultimately will be a much larger addressable market. And I really do believe that U.S. legislation is critical to unlocking that demand.
Yeah, I guess, hopefully that legislation happens soon. Some of the pushback I've heard is around, well, if we move to stables, does the government lose control of policy? Do we move off of U.S. dollar-backed fiat into others, is that kind of off-ramp into losing the power that the U.S. dollar wields? How would you, I mean, to the degree anyone wants to speak to that? Austin?
Yeah, I'll hop into that one and say I think it's actually completely backwards. Stablecoins done properly are backed by U.S. Treasuries. Stablecoins collectively are something like, what is it now, the 11th or 10th largest buyer of U.S. debt, as foreign nation states at the nation state level are reducing their holdings. Individuals in those countries are increasing them by buying stablecoins. If you don't allow the US dollar to move freely on rails where people can use it globally to, pay for things, I think you're going to end up in a situation where we lose dollar dominance much more quickly. I think the other part, as somebody who's lived on both the bank side and the stablecoin side, is a lot of the complaints about, it's going to destabilize the financial system are extremely self-serving. It's not. It's just going to destabilize the deposit base being at zero cost for a lot of the large banks.
Cool. That's helpful context for the group. Well, let's talk a little bit more about the market dynamics. As you see the world evolving in stablecoins, do you envision a world where there's hundreds and thousands of stablecoins? Is there a concentration of a couple at the top? How does that stablecoin world of issuers and kind of the broader market evolve?
I think it looks very similar to asset management. I think you have 5 to 10 players that have 80, 90% market share, and then a long tail of very niche or specialized use cases. The reason for that is, liquidity and utility network effects are very strong, right? You're seeing this with Tether today. Over the last 2 years, right, they've really re-accelerated and actually expanded their market share lead. So network effects are very real. And I think, you probably have 10 issuers in 10 years that each have maybe 50 billion plus 100 billion, right? With, one closer to $1 trillion and maybe some just beneath that. But that's how I think it shakes out.
I'd agree with that. I do think, and going through it, launching a stablecoin is tough business, particularly if you want to walk through the front door and do it in a regulated way. It's expensive. There's a lot of market participants who want to be fed. I think everybody has looked over the last 5 years at what Tether's producing from an economic standpoint and said that must be easy business. I want to get into it. Look at what they're making with 100 employees or whatever they have, if that. And I think that may have proven to be a moment in time. I've got a lot of respect for what they built, but going about it in a different way, going through a fully regulated process is a lengthy, very hard, very expensive, and will be ongoing. It's really a war of attrition to be in the stablecoin business. You need a brand, you need a balance sheet, you need trust, you need regulation, licenses, et cetera. And so I don't think we're going to have many. I do think that we're living in a multi-chain world, and I think you'll see, and maybe it's, like Nick said, 5 to 10, but.
Yeah, I think people think it's simple to launch a stablecoin because, we mentioned, it's vanilla. It's a money market fund. It's actually very challenging and it requires deep network, a lot of experience across technology, capital markets, crypto, finance. PyUSD launched about 15 months ago. So even before Agora was founded, we launched our stable 3 months ago, and we're already doing half the volume of them with maybe 1/100th of the resources. And so I think if you have really specialized teams that understand the markets, they're going to win. And I think a lot of people are going to launch stablecoins over the next year or two and quickly realize it's much harder than they expected.
Nick, on that, maybe just double clicking and then also I'll get to you. What's the approach you took that helped you get that initial volume? Is it a focus on niche or, would be helpful for the group to understand?
Yeah, I think it's a combination of our team and just domain expertise. So I first got into crypto in 2016. I have a very good understanding of the markets, know many of the founders directly because I was a venture investor myself for 5+ years. So I can go right to the top of most of the organizations. One of my co-founders, Drake Evans, was the lead dev at Frac. So he was at the second largest decentralized stable. And then my other co-founder, Joe, was head of global ops at Galaxy for the last 6 years. So we know everyone in the space. We know how to build liquidity, how to build capital markets. And so what we did is go directly to businesses and I think introduce a unique model, which is saying, okay, as opposed to the single partner model that Circle has with Coinbase, where they share half their income with Coinbase, we'll go to every other business and believe that's a much bigger market opportunity. And I think now people have realized that that was a good decision, and you've seen BitGo and now with Glow Dollar literally copying my Stablecoin 3.0 piece verbatim in their announcements, which is fun to see, and I think Austin gets a kick out of, but we'll still, I think, win. So.
Austin,
I was going to say, I do want to go the other way from the group, though. I think there's going to be a lot more stable coins, right? Like, despite the best efforts of my former employer, JP Morgan, there's not just one bank. There's way more than that. And I think one of the things you're going to find is as legislation boots up globally, people disagree and regulators do not coordinate and all have their own rooting interests. I think there may be more regionalization than people expect. So like 5 to 10, like sort of looking like US asset management in the United States, yeah, I buy that, but that doesn't mean China is going to be using those. And so I think you're going to have that dynamic replicated globally all over the place. I would say it differently. There are many different preferences for transactions and structure of money that are both economically essentially driven and then regulatorily driven. And you're going to see the same dynamic play out in blockchains over time because it's just a reflection of the real world.
So to that point, to JP Morgan, to institutions, governments, we're currently in that transition period. What does that stack look like in the next evolution, and what roles do current financial institutions play? What roles do governments play in that whole stablecoin stack and money movement flow? Are they custodians, or are they kind of compliance? Or helpful to understand how you guys think about that.
Yeah, so, all right, this is a much longer discussion, so I'll try to keep this short. Fundamentally, I think historically the role of banks was credit intermediation, right? It's the classic 363, you take money in, you pay your depositors 3%, you lend at 6, you're on the golf course by 3. Obviously, that's a competitive industry, so that last 3 sort of fell apart, and now we murder our analysts. But the punchline is banks are good at credit creation. And through digital transformation in the economy, we kind of inadvertently gave them a monopoly on payments. Right, if you lived in the 1950s, 1960s, 1970s, the only thing you were really doing bank payments for was when you were like buying a car or buying a house, right? Because then you're clearing large money orders or checks. Mostly that's a cash economy. And now literally everything goes through a bank, right? Like go try paying for something in the United States without a bank account or PayPal, good luck. And I think that is what's going to be unwound. So I think banks are going to have to go back to paying depositors more and focusing more on credit intermediation, because if you give people the opportunity to, hey, here's a thing that's only filled with T-bills and you could use it for payments and not worry about your bank going bankrupt, they'll probably start using that.
Anyone else, any comments there on?
I'd just say the one thing that I react to when I hear about different banks wanting to launch stablecoins is that there could be a utility within the bank and the correspondent banking kind of ecosystem. A JP Morgan coin makes a lot of sense to me. I'm not sure that Goldman and Morgan and HSBC, et cetera, are all going to want to use the JP Morgan coin. So I do think that there's a place interbank, and that's where the stablecoins that are more germane to this conversation will have a use case going forward.
Yeah, and I guess in that case, do you imagine you're a customer or a business, what's the relationship they're having with the bank, or do they get disintermediated in a future world with working directly with an issuer, and then they become kind of the primary relationship? How do you see that evolve?
I think you'll see a bunch of neobanks that are just built entirely on top of stables, right? And then they can sort of embed other financial products, maybe that they create themselves or that banks traditionally offer. But that's what I think will happen.
I think the other thing is it's very challenging for banks in their current form factor to interoperate effectively with stablecoins because bank deposits are not fungible, right? Like if you read the BIS paper, some of the people thinking about bank intermediation, they kind of gloss over this problem. But a little while ago, you would have felt very differently having deposits at, say, Wells Fargo versus Silicon Valley Bank, and you would not have been pricing those at the same level. So it's going to cause something we've tried to obscured away after 2008, which is bank credit risk, to just come back to the fore if they try to do it that way. So it raises really questions about the U.S. model of banking, where specifically we've been pretty averse to like e-money companies or narrow banks.
Well, we can do a lot bigger of a deep dive there, so we'll put that aside for now. Maybe just a couple of quick things to touch on as we wrap up. Obviously the bridge acquisition's top of mind to everyone. The stablecoin startup ecosystem, companies are growing. Kind of given the seats you have, any thoughts on the kind of competitive landscape there, and what are there's a bunch of builders here. What are tools that are missing right now? If you kind of zoom out from that stablecoin world and say, hey, it'd be nice if this existed or something like this existed to really drive adoption.
Well, it's something we're focused on at Ripple is being that glue between traditional finance and Web3, right? And I think what the Stripe Bridge deal meant to me was a very credentializing point in time where, specifically for stablecoins, it became obvious to many that this is a perfect use case, the killer app for global payments specifically. But I think there are those bridges that are needed, and presumably those guys are share that vision, and that's why that tie-up exists.
I guess one more question, and then we'll wrap up with a spicy take. I know Austin was probably the dissenting view on the concentration of stablecoins from a top 10 perspective, and the rest. Everyone kind of, if you ask everyone, stablecoins are going to be the next way money moves. It's a very consensus view. What's potentially a non-consensus view around stablecoins that you have that the audience here would enjoy hearing?
All right, I'll go very non-consensus on this one. I think there's a non-zero chance that dollar stablecoins increasingly growing cause a significant counter reaction in other parts of the world when people don't want their currencies essentially run over by the dollar. I don't think capital controls for small places will be effective, but it might cause dramatic reform in the Chinese financial stack, because for a currency to be used as a stablecoin, you need to be able to invest in that currency, right? Like, I get it, and then I've got to do something with it. And that forces you to open your capital markets, right? So if this becomes a significant component of global trade, you kind of have the ability to opt in and take advantage of it, or opt out and have your capital controls become increasingly damaging. It might prove the pivot point for China to change their mind on that.
I agree with that entirely, and we're seeing that already with global governments. Some of them are more welcoming to the stablecoin, dollar-denominated stablecoin. A lot of people want to use a stablecoin just so they can get access to dollars, right? I'll never forget, I had a case, I'm a lawyer by trade, in Venezuela 12 years ago or something like that. And the moment that I got off the plane, the cops came up to me to try to get my dollars, because they knew that it should be 100 bolivares for a dollar instead of 10, where there was that unnatural peg, right? So there's this thirst for dollars around the world, but you're going to see certain countries say, we don't want to be dollarized. And they're going to try to fight this thing tooth and nail. Now, it's a big risk for a stablecoin company, right? Because part of the utility here, as we've already talked about, is that cross-border movement. And so if you start balkanizing the world, now you're starting to look a little bit more like the problems that we already have in our financial system. So we have to do a good job sort of making global governments understand why this is in their interest and their citizens' interest to unlock all these use cases.
I'll throw out another idea. I think you're going to see more interest-bearing stablecoins come onto the market over time. We're a long way away from that in the U.S., obviously for the security issue, but I think that's going to be another unlock of demand where participants who hold them are going to want to participate in the yield as a dollar alternative. And so I think 5 years from now, you're going to see a lot more.
That's actually something I totally disagree with. I think interest-bearing stablecoins are never going to take off. People are just going to use tokenized treasury funds. And the reason why no one will use an interest-bearing stablecoin is there are securities in 70% of global capital markets. And so you don't have the utility or the liquidity that makes a stablecoin like USDC valuable, right? Because you can't actually use it in 70, 80% of the world. So I think you'll actually never see the interest-bearing stablecoins take off. They also don't have the margin to fund liquidity programs. So that's, I don't know, if that was a consensus take, this is my non-consensus take to that.
Well, we can dive in on a future discussion. So maybe just to wrap this up, we're at about 200 billion in stablecoin volume right now. In 2030, just ask each of you to just give me your best guess on where you think we are from a stablecoin volume perspective.
Like AUM, you mean?
AUM, yeah.
I think 3 trillion.
I'm going to be lower than 3, but I think it's because of the market fragmentation that Nick talked about into tokenized treasury funds. So I'll be at about 1, but RWA might be even larger than that.
Yeah, I'm with Austin, right around 1. I think that there is that fragmentation possibility. And when we're talking volume, I mean, we're already in the many tens of trillions of dollars every year moving, right? So that's going to increase exponentially as AUM goes up.
3.1 trillion.
Awesome. Cool. Well, thank you all for the time. Can you guys, everyone give them a round of applause? Thank you.